Gold and crude oil are tracing steep volatility swings amid rising Middle East tensions and risks around the Strait of Hormuz. Hello, everyone. This is Razan Hilal, market analyst with Forex.com, live from Dubai. Today is March 3rd, 2026. Feel free to pause the video and read the following 15-second disclaimer before we go over key levels, defining crude oil's latest steep bullish breakouts, and the overall corrective phase across gold and silver charts and their broader bullish potential. So starting with the gold chart from a daily time frame perspective, we can identify an indecisive daily candle over here on Monday following the opening gap, pricing in the overall Middle East escalations that happened across the weekend. Now over here we have possible exhaustive signals given the small size of that candle and its indecisiveness, followed by the bearish dominance of Tuesday's candle, which reached or dropped all the way down towards the 5,070 low. Now we're testing over here a critical support zone, which was a previous resistance and support to price action since January 2026. A clean close, at least a daily close below the zone, below the 5,070, can possibly expose steeper drawdown risks for the gold chart. In tandem with that, of silvers down towards 4,970, 4,820 to the 4,780 zone. The zone can possibly open the way for either a short-term bullish rebound or expose gold charts for a deeper corrective pattern, possibly dropping back towards the low seen in February 2026 near the 4,380. This level also can set the tone for a corrective pattern for gold chart before resuming its overall bull trend, which has the potential to reach at the 6,000 threshold should we close above the latest 4,000 or 5,430, expecting another record surge towards 5,600 and 6,000 respectively for this year. If we do manage to have a clean close below 4,380, we might be in for another steep drop on the gold charts, potentially exposing the trend towards the 4,000 psychological barrier and further towards the 3,700 zone for potential long-term dip buying opportunities. Now, this concern that we previously saw on gold and is also similar on the silver chart is also due to the steep rise of crude oil despite the escalating tensions in the Middle East and the haven status of gold and silver. And that is because crude oil surging towards these critical levels reasserts inflationary pressures and rate hold expectations across the globe, which is currently strengthening the US dollar index, which is back near the 99 mark, capping the strength seen across gold and silver charts. Now, the crude oil surge is also due to the closure of and the risks of the full closure of the Strait of Hormuz, which allows the passing of supply of 20 to 30% of the world's crude oil and energy through that passageway, which affects global pricing and spreads. So we reached these levels back in June 2025, where we had also an approximate 12-day Iranian war with supply disruption risks also pushing prices near the 78 mark. If we do manage to close above 75 and 78, we can be projecting a medium to long-term bullish forecast for crude oil charts reaching the $90 and $100 per barrel, lining back with highs last seen in 2023. Now, from the downside, should we close back below 75, 72, we can be aiming back towards the opening gap that we saw on Monday near the 69.30 and the 68 zone for potential dip buying and realigning crude oil with potential sustainable bullish forecasts. If not, we can be realigning back with the bounds of that 2.5-year downtrending channel, which reasserted bearish bias across crude oil charts since September 2023. So this channel remains the barrier between reasserting crude oil's bearish bias should we drop back within the bounds of this channel. Further we go away from this channel, the further we can have potential longer-term bullish expectations for crude and inflationary expectations across the globe, which strengthens the US dollar index across major currencies. And as we can currently see from a short-term perspective, the precious metals before they catch up as inflation hedges.